Hey there, trading superstars. Welcome back to Hope Pips, your ultimate destination for conquering the markets. I'm your guide to financial freedom, and today we're diving headfirst into one of the most explosive trading strategies out there, the Wick setup. Buckle up because this masterclass is about to transform your trading game. Woohoo! If you're ready to level up your skills and trade with razor sharp confidence, you're in the right place. In this video, we're breaking down every single detail of the Wick setup, a strategy that's a total game changer. We'll walk you through step by step how to spot this powerhouse pattern in the live market so you can execute trades like a seasoned pro. You'll discover the exact candlestick patterns that must form before your entry candle to confirm the setup, giving you that extra edge to outsmart the market. But that's just the beginning. I'm spilling the tea on my personal experience with this strategy, including the jaw-dropping win rate I've observed in real trades. Spoiler alert, it's phenomenal. We'll also explore whether this setup is a Forex-only superstar or if it dominates other markets like stocks, cryptocurrencies, and commodities. Spoiler, it's a universal beast. We're not stopping there, traders. I'll show you how to master the wick fill setup in both uptrends and downtrends, so you're ready for any market condition. Hi everyone. I hope everyone is fine. Welcome to our channel. If this is the first time you come to our channel, please watch our previous videos, then you will understand this topic well. I will leave those videos and playlist links in cards. Okay, without wasting our time, let's get into the topic. Are you pumped? I know I am. Let's do this course. This video is a cornerstone of our free Forex trading course right here on Hope Pips. As I shared in our last video, the Forex market is ruled by just 8 elite setups, and we're tackling them one by one to make you a trading titan. Last time, we crushed the A+ setup, diving deep into its types, how to spot it in real time, and live market examples to cement your understanding. Today, we're unleashing the second of these powerhouse strategies, the Wick fill setup. To keep things super clear and actionable, I've broken this topic into 6 action-packed chapters. Don't skip a single one, each is a goldmine of knowledge. Here's the lineup. 1. Understanding the Wick fill setup. 2. Spotting the confirmation candle. 3. The golden rules for real market examples. Avoiding fake wick fill traps. 6. Mastering the second entry. Chapters 2 and 6 are universal across all 8 setups, so if you're new to confirmation candles or second entries, pause here and check out our previous videos for a deep dive. These chapters are your foundation for mastering every setup in our course. Before we dive in, let's set the stage. The Wick fill setup is all about reading the market's raw price action. No lagging indicators, just pure market psychology. It's a strategy that's simple yet powerful, but it requires patience and discipline. Ready to unlock its secrets? Let's jump into chapter 1 and discover the magic of the Wick fill setup. Here we go. Welcome to chapter 1, the Wick fill setup. This strategy is like a secret weapon for traders, and I'm beyond thrilled to share it with you. So what exactly is a Wick fill setup? Picture a candlestick on your chart. It has a body which shows the open and close prices, and sometimes it has long lines at the top or bottom. Those lines, they're called wicks or shadows, and they show where the price ventured but didn't stay. In the Wick fill setup, we're hunting for candles where the price fills the gap created by these wicks, creating explosive trading opportunities. Boom, let's paint a vivid picture. In an uptrend, imagine the price is soaring like a rocket, forming higher highs and higher lows. The chart is a sea of green candles, and the bulls are in charge. Suddenly, a bearish candle crashes the party. It breaks the trend structure by closing below a key support level, maybe a previous swing low or a trend line. This candle has a long bottom wick, showing buyers tried to push the price back up, but got slapped down by sellers. That long bottom wick creates a price of interest zone. We call it the filling zone. Why is this zone so special? When the price revisits this filling zone, there's a high probability it'll continue moving downward. Why does this happen? Because big players, think hedge funds, banks, and institutions, are lurking in the shadows, waiting to pounce on this zone. They see that long wick as a liquidity gap, a place where stop-loss orders or retail trader positions are clustered. They swoop in, drive the price to fill the wick, and push it further in their direction. Our job? Follow their lead and grab a slice of the profits. Now let's flip the script to a downtrend. Picture the price plunging like a waterfall, forming lower highs and lower lows. The bears are roaring, and red candles dominate the chart. Out of nowhere, candle interrupts the momentum. It breaks maybe a previous swing high or a moving average and forms a support zone. This shows buyers tried to reverse the trend but got crushed by sellers. When the price fills this wick by moving back up to the zone, it's a signal the downtrend is ready to resume. Wow, that's the wick fill setup in action. Here's the core theory behind its power. When a wick fill candle breaks a key level, like a support or resistance, it creates a liquidity gap. This gap is like a magnet, drawing the price back to test it. Big institutions wait for this moment to enter their massive trades, driving the market in their direction. As retail traders, we're not fighting the market, we're riding the wave created by these giants. This setup isn't just for Forex, it's a universal powerhouse. Whether you're trading stocks like Apple or Tesla, cryptocurrencies like Bitcoin or Ethereum, commodities like gold or oil, or even indices like the S&P 500, the wick fill setup holds an edge. Why? Because it's rooted in price action, the raw language of the market. No lagging indicators, no complicated algorithms, just the pure psychology of buyers and sellers battling it out. Let's dive deeper into the mechanics. In a downtrend, the bearish wick fill candle breaks the structure, signaling a potential reversal or pullback. The long bottom wick shows aggressive selling, but the filling zone it creates is where the magic happens. When the price returns to this zone, it's like a green light for sellers to jump in. In an uptrend, wick fill candle creates a wick, signaling buyer exhaustion. When the price fills that wick, sellers take control, pushing the market lower. One critical point: not every wick fill zone is respected. The strength of the move depends on the volume of institutional traders at that level. High volume zones, like those at major support or resistance levels, are more likely to hold. How do you know? Check the higher time frame, like the 4-hour or daily chart, for confluence. Maybe the wick aligns with a Fibonacci retracement level, a pivot point, or a round number like 1.200 on EUR USD. These confluences stack the odds in your favor. Let's talk about why this setup is so versatile. In Forex, the wick fill setup shines on pairs like EUSD, GBGPI, or XAUSD because of the liquidity and volatility. In stocks, it works on high volume names like Amazon or Nvidia, where institutional traders are active. In crypto, it's killer on Bitcoin or Ethereum during trending markets. Even in commodities, gold's price action often forms perfect wick fill setups at key levels. The key is to adapt the setup to the market's characteristics. Forex moves fast, stocks might need wider stops, and crypto can be a wild ride. Here's a practical tip. Always start with a higher time frame to identify the trend and key zones. On a daily chart, a wick fill candle might signal a major opportunity. On a 4-hour chart, the long wick, it might be a pullback in its lower time frame. On a 30-minute chart, it's your entry precision. This multi-time frame analysis is your secret sauce for success. By the end of this chapter, you should understand the wick fill setup's logic. It's about spotting liquidity gaps created by wicks and riding the wave when big players step in. It's simple yet profound, and with practice, it'll become second nature. Ready to take it to the next level? Let's move to Chapter 2 and uncover the key to confirming this setup. Here we go. Alright traders, welcome to Chapter 2, the confirmation candle. This is the heartbeat of the wick fill setup, and it's absolutely non-negotiable. Without a confirmation candle, you're not trading, you're gambling. Let's dive into why this candle is your ticket to consistent wins and how to spot it like a pro. Why is the confirmation candle so critical? The market is a jungle, full of fakeouts and traps set by big players to shake out retail traders. The confirmation candle is your filter, separating the real setups from the fakes. It's the signal that says, this wick fill setup is legit. Skip it, and you're risking a losing trade. Let's break it down with crystal clarity. In an uptrend, picture the price climbing like a rocket, forming higher highs and higher lows. The chart is a bullish masterpiece, with green candles dominating. Suddenly, a bearish candle breaks a support zone, maybe a previous swing low or a trend line. It closes below the zone and forms a long bottom wick, showing buyers try to defend but got overpowered. This is our wick fill candle, and also it is our confirmation candle signaling a potential sell opportunity. But hold your horses, don't jump in yet. Here's where the entry candle comes in. Wait for the next candle to break the wick fill candle's closing price. That combo is your confirmation setup. It shows the market respects the filling zone and sellers are in control. The candle after it is your entry candle where you pull the trigger on a sell trade. And you'll see the microstructure. The wick fill candle forms, that is our confirmation. The next candle breaks below its close, that is our entry candle, bam. That's your sell signal. Now let's flip it to a downtrend. The price is dropping like a stone, forming lower highs and lower lows. Red candles rule the chart and the bears are in charge. A bullish candle suddenly breaks a resistance zone, maybe a previous swing high or a moving average, and forms a long top wick. This wick shows buyers try to reverse the trend. This is the wick fill candle. Nothing but our confirmation candle. Wait for the next candle to break above the wick fill candle's close. That's your entry candle. This combo confirms the market respects the filling zone and buyers are stepping in. Boom, you're in the trade, riding the bullish wave. Let's make it ultra practical with a scenario. The price surges and you're banking profits. Why does this work? The confirmation candle shows the market's commitment to the wick fill zone. Big players use it to confirm their entries, ensuring the liquidity gap is respected. Without it, you're trading a fake setup and the market will punish you. Here's a pro tip. Always check the lower time frame, like the 30-minute chart, to refine your entry. The 4-hour chart gives you the big picture, but the lower time frame shows the exact moment to strike. Always stack the odds in your favor. By mastering the confirmation candle, you're filtering out 80% of losing trades. It's the difference between trading like a rookie and trading like a pro. Let's keep the momentum rolling into Chapter 3 and uncover the rules that make this setup unstoppable. Here we go. Welcome to Chapter 3, the golden rules of the wick fill setup. These rules are your trading compass, guiding you through the market's chaos to consistent profits. Without them, emotions take over and mistakes creep in. Let's dive into the 3 essential rules, all centered on wick reading, the art of decoding candlestick wicks to spot high probability setups. Trading without rules is like sailing without a map. You'll get lost fast. These rules are designed to keep you disciplined, focused, and profitable. They're specific to the wick fill setup, so memorize them and apply them religiously. Let's break them down. Rule 1. Short wicks. Short wicks are the hallmark of a high-quality candle and a strong trend. A short wick means the price didn't venture far from the candle's body, showing one-side buyers or sellers is in total control. In a bullish trend on a 4-hour chart, a candle with a short top wick signals a pullback in a lower time frame, like 30 minutes. This tells us the bulls are dominating and the trend is robust. This short wick signals trend strength, so you prepare for a trade. Wait for the confirmation candle to close above the wick fill candle's close. Then enter when the next candle breaks the confirmation candle's closing point. Set your stop loss below the wick fill candle's low or entry candle low and target the next resistance. Short wicks are your green light for trending markets. Rule 2. Regular wicks. Regular wicks are when the wick's length is not exceeding 50% of the candle's body, balanced and reliable. These wicks show a tug of war between buyers and sellers, but the confirmation candle tips the scales. In a downtrend, a bearish candle with a regular bottom wick at a support zone is a screaming sell opportunity. Let's say you're trading XAUSD gold on a 4-hour chart in a downtrend, forming lower highs and lower lows. The price hits a support zone at 1,800, marked by previous lows. A bearish candle breaks this zone, closes at 1,795, and forms a regular bottom wick down to 1,790. On the 30-minute chart, this wick is a brief buyer push before sellers take over. The next candle closes below 1,795 confirmation. You enter a sell trade when the following candle breaks below the confirmation candle's low with a stop loss at 1,800 and a target at 1,780. Regular wicks are your bread and butter setups, offering reliable entries with proper confirmation. Rule 3. Long wicks. Long wicks are the superstars of the wick fill setup. They signal strong rejection and a powerful market bias. A long wick shows the price ventured far but was aggressively pushed back, often by institutional traders defending a key level. In any trend, a long wick at a key zone, like a support or resistance, is a magnet for price action. Long wicks are high probability setups, especially at major levels. Here's a critical tip. Always check the higher time frame, like the 4-hour or daily chart, to confirm the trend. Short wicks signal trend strength, regular wicks show balance, and long wicks scream rejection. Use multi-time frame analysis to stack the odds in your favor. Let's add a practical layer. In a bullish trend, a short top wick on a 4-hour candle might be a 30-minute pullback. Check the lower time frame to confirm the resistance zone holds. In a bearish trend, a long bottom wick on a 4-hour candle signals buyer exhaustion. The lower time frame will show the exact entry point after confirmation. How do you identify the trend without indicators? It's simple. Look for higher highs and higher lows, or lower highs and lower lows. Forget moving averages or RSI. They lag and we're trading price action like pros. One more tip, in trending markets, stick to the trend direction. In an uptrend, focus on buy setups. In a downtrend, focus on sell setups. For beginners, the trend is your friend. These rules are your shield against market chaos. They keep you focused on high probability setups and away from emotional trades. Memorize them, practice them in a demo account, and watch your trading soar. Let's see these rules in action in Chapter 4 with real market examples. Let's go. Chapter 4 is where the wick fill setup comes alive, real market examples. Let's dive into trades to show you how to spot, confirm, and trade this strategy like a pro. Grab your charts because this is where it gets exciting. Example 1, uptrend by trade. Picture EUR/USD on a 4-hour chart in a bullish trend forming higher highs and higher lows. The price hits a resistance zone at 1.2100 marked by two previous swing highs. A bullish candle breaks this zone, closes at 1.2090 marked by two previous swing highs. A bullish candle breaks this zone, closes at 1.2090 and forms a long top wick up to 1.2110. This is our wick fill candle, signaling a liquidity zone where sellers rejected buyers. On the 30-minute chart, this wick is a sharp pullback showing buyer exhaustion. The next candle closes at 1.2095 above the wick fill candle's close of 1.2090. That's our confirmation candle. The following candle opens at 1.2095 and breaks above 1.2095. You enter a buy trade at 1.2110, set your stop loss at 1.2080, and target the next resistance at 1.2150. The price rockets to 1.2150 and you're banking a 50 pip profit. Let's visualize the chart. The 4-hour chart shows a clean uptrend with green candles pushing higher. The wick fill candle forms a confirmation candle is a green candle with a healthy body, showing buyer strength. The entry candle breaks the confirmation candle's closing point, and the price surges. This is pure price action trading. Example 2, downtrend sell trade. Now let's switch to BTC/USD on a 4-hour chart in a bearish trend, forming lower highs and lower lows. The price hits a support zone at 68,000, marked by previous lows. A bearish candle breaks this zone, closes at 67,900, and forms a long bottom wick down to 67,800. This wick fill candle shows buyers tried to defend but got crushed. On the 30-minute chart, this wick is a brief buyer spike before sellers take over. The next candle closes at 67,890, below the wick fill candle's close of 67,900 confirmation. You enter a sell trade when the following candle breaks below 67,890 at 67,880. Set your stop loss at 68,000 and target the next support at 67,600. Wow! The price plunges to 67,600 and you're cashing in a 280-point win. On the chart, the 4-hour downtrend is a cascade of red candles. The wick fill candle is a green candle with a long bottom wick showing buyer rejection. The confirmation candle is a red candle with a solid body confirming seller control. The entry candle breaks the closing point and the price tanks. Crypto volatility makes this setup a goldmine. These examples prove the wick fill setup's power across markets, Forex, crypto, stocks, you name it. Practice spotting these setups in a demo account. Start on a 4-hour chart for the big picture, then zoom into a 30-minute chart for entry precision. You'll be trading like a pro in no time. Let's move to Chapter 5 to avoid those pesky traps. Here we go. Chapter 5 is a must, avoiding fake wick fill traps. Big players love setting traps for retail traders, and we're not falling for them. Out of 10 wick fill setups, at least one is a liquidity grab designed to trick you into a losing trade. Let's uncover the secrets to staying one step ahead. Example 1. Bullish trap. Picture USD JPY on a 4-hour chart in an uptrend, forming higher highs and higher lows. The price hits a resistance zone at 110.00, marked by previous highs. A bullish candle breaks this zone, closes at 109.90, and forms a long top wick up to 110.20. It looks like a perfect wick fill setup, right? You wait for the confirmation candle, but the price keeps rejecting the zone, forming multiple candles that fail to break higher. What's going on? Switch to the 30-minute chart. A massive bearish engulfing candle is forming at 110.0, signaling a potential reversal. On the 15-minute chart, the structure is shifting. The price is forming lower highs, hinting at a trend change. This is a red flag. The wick fill setup is a trap designed to lure retail traders into buying before the price collapses. Skip this trade and you've saved your capital. On the chart, the 4-hour wick fill candle looks promising, but the 30-minute chart's rejection candle is a warning. The 15-minute chart shows a breakdown in structure, confirming the trap. Multi-time frame analysis is your superpower. Example 2. Bearish trap. Now ETH USD on a 4-hour chart in a downtrend, forming lower highs and lower lows. The price hits a support zone at 2,500, marked by previous lows. A bearish candle breaks this zone, closes at 2,490, and forms a long bottom wick down to 2,480. You wait for the confirmation candle, but the next candle closes bullish at 2,510, and the price surges upward. What happened? Check the 30-minute chart. A bullish pin bar is forming at 2,500, signaling buyer strength. On the 15-minute chart, the price is forming higher lows, hinting at a reversal. This wick fill setup is a liquidity trap designed to trap sellers before a rally. Stay out and you've dodged a bullet. The chart shows a tempting 4-hour wick fill candle, but the 30-minute chart's bullish signal and the 15-minute chart's structure change scream danger. Always check multiple time frames to avoid these traps. Why do these traps happen? Big players know retail traders chase wick fill setups. They push the price to trigger stop loss orders, grab liquidity, and reverse the market. How do you avoid them? Multi-time frame analysis is key. If the higher time frame shows rejection or the lower time frame shows a structure change, it's a no trade zone. Here's a pro tip: look for confluence. If the wick fill zone aligns with a Fibonacci level, pivot point, or round number, it's more likely to hold. If it's a random level with no higher time frame support, be cautious. Risk management is your shield. Never risk more than 1 to 2% of your account on a single trade. Losses teach us, but avoiding traps makes us unstoppable. Practice spotting these fake setups in a demo account, and you'll develop a sixth sense for danger. Let's wrap up with Chapter 6 and master the advanced second entry. Let's go. Chapter 6, Mastering the Second Entry. Our final chapter is for the fearless, the second entry. This is an advanced technique, so beginners, practice this in a demo account before going live. If you master this, you'll be outsmarting the market like a pro. Sometimes, a perfect wick fill setup does everything right. The wick fill candle forms, the confirmation candle confirms, and you enter the trade. But then, the price moves halfway to your stop loss, hits it, and reverses back to your entry level before soaring to your target. Frustrating, right? The second entry is your solution to capitalize on these tricky moves. Here's how it works. Let's say you're trading a buy setup on GBP/USD in an uptrend. The wick fill candle forms at a resistance zone, the confirmation candle closes above, and you enter a buy trade at 1.3800 with a stop loss at 1.3780 and a target at 1.3850. The price moves to 1.3790, halfway to your stop loss. Instead of panicking, close 50% of your position to reduce risk. Now watch the price. If it returns to your entry level and breaks its own high, re-enter the trade with half your original risk. Your stop loss stays at 1.3780 and your target remains 1.3850. If the price hits your stop loss first, you've minimized your loss. If it reverses and hits your target, you've scored a win with lower risk. Boom, you're banking profits. Why does this happen? Big players often trigger stop loss orders to grab liquidity before the real move. The second entry lets you in the trade after the shakeout. Here's a visual. On the 4-hour chart, the wick fill candle forms a long bottom wick. The confirmation candle confirms and you enter. The price dips, triggering stops, then reverses. On the 30-minute chart, you see a new low followed by a strong reversal candle. That's your second entry signal. This technique requires patience and precision. Practice in a demo account for at least 100 trades to master it. Start with small position sizes and only use the second entry on high probability set for strong confluence. For advanced traders, you can combine the second entry with other strategies, like trailing stops or scaling in. The second entry is not for beginners. It's an advanced concept that demands discipline. But once you nail it, you'll be filling your account with profits while others are stopped out. Practice, 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 and you'll be a trading ninja. Let's wrap up this masterclass with some final thoughts. The wick fill setup is a powerful tool, but it's not a magic bullet. Combine it with solid risk management, never risk more than 1 to 2% per trade, and a trading plan. Test it in a demo account for at least 50 trades to build confidence. You've got this, traders. Take these lessons, apply them, and watch your trading soar. Let's move to the outro and send you off with a bang. Here we go. And that's a wrap, trading legends. You've just mastered the wick fill setup, a strategy that'll take your trading to the next level. You're now equipped to spot, confirm, and trade this powerhouse pattern like a pro. Hit that demo account, practice these 6 chapters, and watch your skills skyrocket. If you loved this video, smash that like button, subscribe to Hope Pips, and ring the bell for more trading gold. Drop a comment below. What's your favorite part of the wick fill setup? Have you tried it in Forex, stocks, or crypto? Let's connect. Share this video with your trading buddies, and let's build a community of unstoppable traders. Until next time, trade smart, stay disciplined, and I'll see you in the markets. Thank you. This is the end of the video.